Welcome to Echo Trade. I'm Jeff Roth, and we are here today with Thurman Kelley from Brookmont Capital Management. You know, Thurman is, I think they're based out of Dallas, but Thurman is pretty much a global traveler. Every time I talk to him, he's somewhere different. But we're here today to talk about the dividend growth portfolio that Brookmont offers within Echo Trade. So, quick background on Thurman: he's got economics degree, background at J.P. Morgan Chase. Founded his own fintech startup himself, and he's on the investment committee at Brookmont, which I think between the three or four of you that are on the committee, or four of you, there's probably combined 100 years of experience. But I appreciate you being here, Thurman. Thanks for taking the time.
Yeah, thanks for having me. We're very excited for Echo Trade, and anything we can do to help out and educate, especially on our dividend growth strategy. It's easy for us to talk about since we do it every day, all day.
Yeah, absolutely. So let's dive into it. So, I kind of wanted to start a little bit broadly speaking and hear kind of, where you can kind of tell the investors from your perspective, what's the overarching kind of thesis of the portfolio and kind of just give me the broad strokes and the overarching goal of the portfolio of dividend growth.
Yeah. So the portfolio is an all equity portfolio. We're always 100% invested into the stock market. And the names that we own are names that have grown their dividend at least 2 out of the past 3 years. And they also have to yield about 50% greater than whatever the S&P 500 is yielding at that time.
Got it.
So that's kind of our minimum, kind of what we filter out just to begin our process. And then from that point, we are very much a fundamental analysis shop, meaning that our team of analysts are breaking down every single company that fits that qualification and is intimately looking at where these cash flows are coming from. We mostly invest in companies with very strong balance sheets that don't have to use any kind of debt in order to fuel their dividend moving forward. That's a big no-no for us because we want these companies to be able to actively pay their dividend instead of just, leverage up to continuously pay it. Because if a company can continuously grow their dividend off of just natural operations, we found those companies to be the strongest, but they've also invested very wisely in their businesses to continuously grow while still rewarding the shareholder with some dividend yield in the meantime.
Got it. So the dividend companies are the focus for you. Obviously dividend growth. So, is that the primary goal is to drive, dividend yields and income from those dividends? Or is it, obviously there's the growth portion of it, or is the dividend kind of, fueling the growth as well? So how do you guys look at that in terms of, again, kind of what's the overarching kind of goal that we're trying to accomplish, kind of whether on a short term or a long term from a income generation and capital growth standpoint?
Yeah, so we're very much more of a total return portfolio. We just use the dividend growth history and projections and the dividend yield as kind of a starting point to just find good quality companies with strong balance sheets. And we hold these companies for a very long-term basis. So our holding period is typically 3 to 5 years.
Yeah.
But with that being said, we have some names in the portfolio that have never left because they're just good, solid names. So like Home Depot is basically in a duopoly with Lowe's, and we own Home Depot, and they've been in the portfolio since the very beginning. So we're really picking industry leaders across the entire financial sector or the entire stock market. So we're always invested in every sector of whatever the S&P 500 considers a sector these days. So I believe it's 11 sectors right now. We always have some kind of representation in all those sectors. So we're very much a total return portfolio, but we have the dividend yield as a way to help, provide some kind of income to clients. But the real end goal is a total return. So we're just using that dividend yield to really qualify good companies that can grow on a long-term basis.
Got it. And so, with that, is that a portion of the investment process, obviously, in terms of identifying what companies to purchase, the yields that they're giving on the dividend side sounds like at least an initial factor. And then obviously you guys are, diversifying across all sectors. But talk about a little bit about how you guys are mitigating and managing risk. Is it, just the companies you're investing in, or is there any other kind of, diversification or any other kind of tools that you're using to mitigate and manage that risk? And how would you guys quantify your risk? Like, are you guys a high risk, a low risk, medium risk type of portfolio in relation to others?
Yeah. So since we are 100% invested in the stock market at all times, we don't own any fixed income or anything that um, I would say that we have a moderate risk, but our portfolio is built for those who want to get exposure to the stock market with less risk than just the S&P 500. Because especially right now, this year, the S&P 500, I believe there's like 6 names that make up over 25% of the S&P 500. So that's not
Yeah.
actually a very, very diversified investment.
Uh-huh.
So we're definitely, I would say, moderate risk depending on your risk appetite. But within the stock market, just if you're an all equity investor, I would say we're probably more of a low risk just because we have very strict risk mandates to manage that risk. And we have a very kind of low downside capture. So our downside capture since inception is about 65%. So and we use the Russell 1000 value as our benchmark. So whenever
So downside capture, you're meaning, so if the market falls 50%, you're only participating in about 65% of that downturn.
Yeah, exactly.
Yeah.
So we're very much a wealth preservation strategy for those who want, an all equity portfolio. That's the goal. So this strategy was actually developed in the trust department of Comerica Bank with definitely wealth preservation in mind, but with those clients that want equity exposure. So that's where the strategy came from. And we haven't tinkered with it since. But we have very strict risk mandates that help us with that downside capture. One of those being that we cannot allow one individual position to go above 5% of the portfolio. And then also we are always plus or minus 5% of whatever the benchmark sector weighting it is. So let's say that the energy sector makes up 10% of the Russell 1000 value. We can go up to 15% in our portfolio, and we can go down to 5%. Of energy exposure in the portfolio, but we can't go outside those guardrails because the nature of our product is just to pick the best industry leading stocks in every sector and not take any large sector bets that could be influenced by large, macroeconomic driven events or today's environment, geopolitical events that are influencing certain markets. So as much as, in a certain environment, we might love energy, but if we're 10% overweight in energy and something crazy happens with OPEC or Russian oil gets turned back on, energy prices collapse as a result, it's not going to blow up our portfolio because we've managed that risk very well.
Got it. Yeah, because some people, they're going to look at, they're going to say, hey, listen, I'm looking at these 4 sectors that I really like right now, and they're going to ignore the additional 5 or 6 or 7 or whatever it might be, right? How they're being defined. But you guys are saying you're going to be invested in all sectors at all times, but with that guardrails of, hey, if we really like financials or energy right now, we might go up to 15%, but that's the cap, and the bottom is going to be 5%. But you're fully diversified across sectors.
Exactly. Yeah. So the whole goal of it is to get stock market exposure with much less risk than the overall market. So we're always looking to take $100 and turn it to $110 this year, with the risk of maybe it going down to 90. While some other managers will try to take 100 and turn it into $140, but then you could go down to $60. We're really trying to manage that risk very appropriately for our clients, just because we do have kind of the trust department thought in our head when we created the strategy and took it private with Brookmont.
Yeah. So what does the investment process look like on an individual name, an individual company that you guys are looking at? Like, what kind of research is done? What's the analysis that you guys are going through when you're screening this, individual companies, and what does it take to get into the portfolio?
Yeah, so I mentioned our initial screens of a yield 50% greater than whatever the S&P 500 is yielding at that time.
Yeah.
And then they must grow their dividend at least 2 out of the past 3 years. And that's just a starting point. Once that happens, we usually have about 200 to 300 stocks that could qualify for the portfolio. And then our team of analysts are going down and we're going through all the 10Ks. We're creating our own models necessarily from our investment team. So we have our own kind of valuation process. We think this could be worth, X price. But with that being said, we're not just, a traditional value manager is like, well, it's, tangible value or whatever is, $100 a share. We want to buy it at $80 a share. And when it goes up to 100, that's when we're going to sell. Yeah. We're looking for kind of a little bit more growth factors in these things. So as much as we like Microsoft at, $80 a share, we'll still buy it at 90 because we think over 5 years they have such good growth prospects that it could be worth 150. So we're very much different than kind of the Benjamin Graham value investing. We're still looking at a lot of growth factors and secular trends within these companies that can really grow them on a long-term basis. So a lot of what we do is look at where they're reinvesting their capital and how efficient that is. So a return on invested capital is a good statistic to look at, just to make sure that the management team is actually doing their job and reinvesting very wisely while still able to grow their dividend. Because we want companies that can continuously grow their dividend, and that takes very smart capital allocation. So we dive very deep into that to understand where this money is being invested and what kind of return they can get on, instead of just running blind screens like, hey, they've grown their dividend for the past 25 years. And they have a low PE ratio, so we're going to invest in them. That's not what we do. We're looking for very much some secular growth trends within these companies, and also certain industries. So like healthcare is a good one that we've had great exposure to, but a lot of that's been tied to kind of the growth of insulin and these new kind of weight loss drugs. We saw these coming for 5 years, so we invested in Novo Nordisk a long time ago because we knew these drugs were coming down their pipeline. But with that being said, they were still having smart capital allocation and continuously growing their dividend and trying to keep a clean balance sheet. So it's kind of a balance of a well-run, balance or strong balance sheet, well-run company while still reinvesting in some new growth areas. So I would say our ideal company is a traditional value company that turns into a growth company because they've been able to invest in some high growth project. That doesn't always happen, but that's the ideal situation for us.
Yeah, and value again, for the investors, the way you're looking at it as the price might be at $100 per share or $80 per share right now, but you look at the value actually being at $100 per share, and so you're getting at a value per on a relative basis. But again, growth being, I don't care if it's at $120, I think it's going to go to 200, and so you're kind of looking at it from both sides of this. But you're a value manager, but you also take into that growth factor. It sounds like, correct?
Exactly. Yeah, we can't just look at valuation alone. There's a lot more to a company than just the valuation. We're not buying stocks, we're buying companies. So we want to map out and figure out where these investments they've made are going to lead it in the next 5 years. And that's why we hold these companies for a long term and don't do any short-term trading. I mean, our annual turnover rate, meaning how often we trade names, is always between 5 and basically 15%. The highest it ever was 2020 when we did 20% turnover. And that's because we were during March of 2020, we were looking at Bank of America trading below its like bank value and Wells Fargo as well. It's like, all right, we got to buy these good names. They're so cheap right now. How could you not do it? So traditionally we're between 5 and 15% of annual turnover.
Yeah, so you're looking for the long-term growth, like you said, 3 to 5 year time horizon. But like Buffett says, ideal is to never sell, so you can hold on to it if it continues to look good within the portfolio. But I would imagine, if something's underperforming, then you can kind of get rid of the losers quickly if you see any negative impacts that were not there when you initially kind of made that purchase.
Yeah, so a good example of that would be like Paramount in the first quarter. This year, they reported their quarterly earnings from the last quarter of 2022, and we saw kind of the writing on the wall. We're like, their cash flow is running pretty dry right now. They're not going to be able to continuously grow this dividend with the way they're going right now. They're going to have to, take out some more debt in order to fuel the dividend or cut their dividend. So when we saw that, we sold out of them pretty quickly. Whenever the fundamentals start to break down on a company, we're watching these things every day, all day. This is all we do. So all we do is dividend growth strategies. So the names that are in the portfolio, our team are watching very intimately throughout the entire year. So we saw this kind of the writing on the wall. We sold out of it. And then, of course, the next quarter, they cut their dividend on the earnings call, and it drops 20% right there. So there's no like set, sell discipline, like, hey, they're, below some valuation or anything like that. It's more of continuously monitoring these companies. Just because the way our company's set up, we have the ability to do that.
Yeah, no, that's fantastic. So, I mean, I think to wrap it up, can you just kind of quickly talk about what sets you guys apart, maybe from other managers, maybe within the echo trading platform, but kind of in the broader asset management industry as a whole. How do you guys kind of see yourself as set apart?
Yeah, so one reason that we're different, especially from if you're just talking about the dividend growth kind of section of asset managers, we have that 2 out of the past 3 year requirement. A lot of dividend growth managers have a 5 or 10 year minimum requirement just to enter the portfolio. Now, it's a good sign that a company's grown their dividend 5 consecutive years or 10 consecutive years. But with that being said, we don't want to lose out on any dividend initiators. So if maybe they've grown their dividend for 4 years, they're not going to qualify, even though if they've been growing their dividend pretty well for 4 years and aggressively, it sounds like they're a pretty well-run company with very differentiated products that continuously grow as well. So that's where we're different, is because we have that 2 out of the past 3 years. And then occasionally in financial markets, you get something freakish like COVID happens, and a company that's been very well run forever, might make the prudent move to cut their dividend. So in 2020, Royal Dutch Shell cut their dividend for the first time since World War II. And then on the counterpart, you had Exxon, who did not cut their dividend and had to take out debt just to fuel it during that time. So they took out, I think, $9 billion worth of debt just to maintain their dividend through kind of the economic shutdown period. And instead of getting rid of Royal Dutch Shell just because they cut their dividend during that time, we thought it was a prudent move by management to cut that dividend, because we knew they were going to reinstate it whenever they could, whenever demand bounces back. We were never worried about demand going away. We knew it was going to bounce back, but we were willing to take Royal Dutch Shell's risk of cutting their dividend just to shore up their balance sheet and become a much more stable company, as opposed to Exxon, who had to take out additional debt for that. So as a result, Shell became a much more profitable company on a long-term basis with a very aggressive plan to return capital back to shareholders through dividend growth and share buybacks as well. So we chose to hold on to them because we felt that was a better plan and prudent. So a lot of these other dividend growth managers were like, hey, you don't check the box anymore, so we got to sell out of you, even though you're probably going to have a very good outlook for the next 10 years.
Yeah. Because they're more just looking at, mandates within their own portfolio on they have to, like you said, check those boxes, but you guys are a little bit more tactical when you can, make those decisions.
Yeah. I would say we're more qualitative than
Yes.
a lot of the other managers in our section. We're really coming up with our own investment rationale and theses, and we play those into our models. We're not just, ripping off models from Bloomberg and Wall Street, and running blind screens. We're intimately breaking these companies down and seeing where they're investing, and if that's new, industry that they're getting in, or if they're able to, like during a recessionary period, are they able to capture more market share during that time because they have a much stronger balance sheet than their peers, so they're able to get a little bit more aggressive during a recessionary time. So we're looking at a lot of different factors on a qualitative basis, and I don't think all of our peers kind of put all of that into their process as well.
Well, that's great. I mean, I clearly know what you're talking about, and with the rest of the investment committee there that you guys are working with, I'm thrilled that you guys have, the dividend growth portfolio within Echo Trade, and you guys are offering your expertise to another level of investors. So appreciate it, Thurman. Thanks for taking a few minutes.
Yeah, thank you. I'm always happy to chat, and always feel free to reach out.
Yep, perfect. And investors can find the dividend growth portfolio within Echo Trade.